Hi guys, inflation slowed substantially in 2023 as the Fed lifted interest rates to nearly a quarter-century high and held them at that level since last July. The Fed has indicated several times that it is planning to cut interest rates in the second half of 2024. But what does it mean for investors? It is a clear signal that investors should turn toward debt funds and invest there instead of buying company shares. It is true that the Fed is expected to cut interest rates 3 times this year, starting from June, and the markets have priced in those cuts. Nevertheless, you don't have to take those statements coming from the Fed too seriously, because their opinions can change overnight together with the change in the market sentiment. By today, the equity market valuation has been a little bit high without a single crash happening in the past 2 years. Shares couldn't really go higher, partly because the Fed has had interest rates steady at 5.5% since July 2023. The Fed's policy is not so favorable for stock investments. That's why bulk buyers turn toward debt funds, or widely known as mutual funds. Well, it has never been the Fed's main policy to help equity markets thrive. Instead, it tries to help the economy go ahead and cut back on inflation. So lower inflation could create stability for the economy. But as progress toward lower inflation has stalled, the Fed felt it necessary to keep interest rates highly elevated. Due to this policy, equity markets couldn't shine and bring nice double-digit profits for investors in the past 2 years, though a bigger flash crash never occurred either. As equity markets performed flat results in this period, fund managers turned toward mutual funds. A debt fund is a mutual fund scheme that invests in fixed income instruments, such as corporate and government bonds, corporate debt securities, and money market instruments that offer capital appreciation. Debt funds are also referred to as fixed income funds or bond funds. What are the advantages of debt funds? First, they have a relatively low cost structure, relatively stable returns, relatively high liquidity, and reasonable safety. Debt funds are ideal for risk-averse investors because they are less volatile and hence are less risky than equity funds. You can earn better returns with debt funds today than with equities or government bonds only. Another mutual fund scheme can be an equity fund. As its name indicates clearly, it invests predominantly in shares of companies. They are also known as growth funds. In an active fund, the fund manager inspects the market, conducts research on companies, examines their performance, and looks for the best stocks to invest in. Equity funds can also be divided according to market capitalization. So there can be large cap, mid cap, small cap, or micro cap funds. And as we discussed before, it's not the right time to invest in equities as your portfolio won't be diversified. So this economical situation where economies are struggling with stopping higher inflation, you can't have decent profits with equities. So forget about equity funds and choose debt funds instead. Diversification is more important today than it has ever been before. On the other hand, I warn you of an imminent flash crash soon in the stock markets. This impending disaster can happen at any time soon without any reason or signal, as it is very typical of the stock markets and the tiniest bad news on anything like economy, interest rate cuts, change of the Fed's schedule on rate cuts, or wars in the Far East or Middle East, or in Europe, or a conflict between Islamic states and Israel. As everything is linked to everything in the stock markets and in the real world, a conflict between Islamic states and Israel can have negative effects on the stock markets as well. While the United States, Britain, and France strongly condemned Iran's actions and swiftly came to Israel's defense to help intercept Tehran's strikes, their calls for restraint highlighted the intense pressure Israel was facing not to fuel a wider Middle East conflict. Since the United States, Great Britain, and France belong to Israel's best allies, therefore any message, act, or intervention, whether relevant or irrelevant to the Israel-Iran conflict, can have serious impact not only on the Middle Eastern stock market, but on the performance of the European and American stock markets too. So European governments and the US government can intervene in the Middle East conflict to save Israel, but at the same time they will also ruin equity markets. The US was the first country to offer de facto recognition to the new Israeli government when the Jewish state declared independence on the 14th of May 1948. 75 years later, Washington has long been Israel's strongest military and diplomatic ally. After several Arab-Israeli wars, Egypt was the first Arab state to recognize Israel diplomatically in 1979 with the signing of the Israel-Egypt Peace Treaty. It was followed by Jordan with the Israel-Jordan Peace Treaty 1994. In 2020, 4 more Arab states, the UAE, Bahrain, Morocco, and Sudan, normalized relations. 28 UN member states do not recognize Israel, 15 members of the Arab League, Algeria, Comoros, Djibouti, Iraq, Kuwait, Lebanon, Libya, Mauritania, Oman, Qatar, Saudi Arabia, Somalia, Syria, Tunisia, and Yemen. 10 non-Arab members of the Organization of Islamic Cooperation: Afghanistan, Bangladesh, Brunei, Indonesia, Iran, Malaysia, Maldives, Mali, Niger, and Pakistan, and Cuba, North Korea, and Venezuela. As I said before, everything is connected to everything in the stock markets, so the development of Middle East economies and European economies are inextricably linked. As I outlined before, negative news spreads much faster than positive news on the stock exchange. So be warned, any intervention in the Israel-Iran conflict by European allies or the USA can cause flash crashes in the stock markets. So that's why Israel's allies were so anxious to avoid an escalation of conflict in the Middle East, and they called for restraint when Israel's military chief said his country would respond to Iran's missile and drone attack. Iran's attack, which was launched in retaliation for a suspected Israeli airstrike on its embassy compound in Damascus on April 1, 2024, has increased fears of open warfare between Israel and Iran and heightened concerns that violence rooted in the Gaza war is spreading further in the region. Wary of the dangers, President Joe Biden told Netanyahu the United States will not take part in any Israeli counteroffensive against Iran, officials said. Since the start of the war in Gaza on October 7th, clashes have erupted between Israel and Iran-aligned groups in Lebanon, Syria, Yemen, and Iraq. Israel said 4 of its soldiers were wounded hundreds of meters inside Lebanese territory overnight. It appeared to be the first such known incident since the Gaza war erupted, although there have been months of exchanges of fire between Israel and Lebanon's armed group Hezbollah. "We are on the edge of the cliff, and we have to move away from it," said Josep Borrell, the European Union's foreign affairs chief. French President Emmanuel Macron, German Chancellor Olaf Scholz, and British Foreign Secretary David Cameron made similar appeals. Washington and United Nations Secretary General Antonio Guterres have also issued calls for restraint. Now you could have an insight into how conflicts in the Middle East can have a strong impact on the performance of the stock markets. Even the speeches of these officials who speak on the subject have a profound impact on asset managers and trustees. The US dollar is also involved in this matter. It strengthens or weakens on the news. The US dollar is significant in this respect because it is a currency that investors turn to when there is a danger to the US economy. In this case, America is related to Israel, and if the country gets into conflict with Iran through Israel, then the US dollar is also involved in the matter. But the oil industry is also involved, and so is the bigger group, the commodities market, that is, the futures markets on the stock exchanges. The US dollar also starts moving south or north on the news communicated by the Fed. If the economy does not perform well and inflation remains a high risk, the US dollar can strengthen against major currencies. It is also true that if the US economy does well, because of a strong president, for instance, but at the same time there is no trust in the economy nor toward the performance of the president or the companies, the US dollar will again strengthen on the bad news. It seems to be a little contradictory, doesn't it? But one of the special characteristics of the US dollar is that it begins to strengthen on bad news about the US economy. But then when will the US dollar weaken? The answer is simple. For instance, when stock market investors and big fund managers expect the Fed to hold interest rates steady, as it is the case these days, but the Fed announces a surprise cut or a rate hike, that intervention can have a bad impact on the dollar. Or when there is a long-term economic boom, mainly globally, the US dollar will weaken. So easy monetary policy by the Fed can weaken the US dollar, because investors take their capital out of the US, searching for high yields elsewhere. On the contrary, typically in times of economic downturn or in recession, investors tend to pull out of emerging markets and seek safer investments in more stable currencies such as the US dollar, Swiss franc, and Japanese yen. As a result, these currencies appreciate in value, while emerging market currencies depreciate, leading to fluctuations in FX rates. During times of economic stress, flight to safety means traders often need to liquidate market positions. Their go-to choice is often US dollars, making it a haven-linked trading instrument. This influx of demand helps explain why the currency tends to rise during recessionary periods. compared to a handful of assets, the US dollar tends to do the best during the onset of recessions in the United States. In a global slowdown, the USD will benefit from safe haven demand. On the contrary, when there is only a mild economic recession in the US, which is unlikely to spill over to the rest of the world, so the weight of the US in the global economy is less in that period, the global growth can outperform that of the US economy. In an environment of such strong global growth, the USD will weaken against other major currencies. So you have to look at and analyze the current state of the US economy and compare it to the economies of other countries around the world. Then you can make guesses what will happen to the US dollar. If you liked my video, please don't forget to subscribe or follow me. See you guys in my next video.